Congratulations on the raise. Now here's the part nobody in HR mentions when they shake your hand. For a real number of people who get one this year, that raise is going to quietly cost them money. Not because of some evil corporate scheme, and not because of the reason you're probably thinking either, which is the tax bracket thing. Forget the bracket thing for a second. The actual trap sitting underneath your raise is something almost nobody explains. It doesn't show up until months later, and by the time most people notice it, they've already lost the money. I'm going to walk you through exactly what it is, exactly which situations trigger it, and exactly what to check before your raise even hits your first paycheck. If you're new here, hit subscribe. I cover exactly this kind of thing, the stuff buried in the fine print of your own financial life every single week. I want to talk directly to the 30, 40, and 50-somethings watching this, because this particular trap has a very specific sweet spot, and a lot of you are sitting right in it without realizing. You're past the entry-level years, so raises are actually meaningful now, not just a few $100s. You might have kids at home, which puts you squarely in child tax credit territory. You might be self-employed or between employer health plans, which puts you in ACA marketplace territory. And there's a real chance you're still carrying student loans from a degree you finished 15 or 20 years ago, which puts you in income-driven repayment territory. Younger workers usually aren't close enough to these thresholds yet for it to matter. Much older workers are usually on Medicare and off these plans entirely. It's specifically this middle stretch of working life, the stretch where your income is finally climbing and your obligations are at their peak, where every single one of these thresholds does its most damage. Let's clear up the bracket myth first, because I guarantee some of you are already thinking that's the trap, and I need you to let it go before we get to the real one. You've heard someone say it, maybe you've said it yourself. I don't want the raise, it'll just push me into a higher bracket and I'll take home less. That is completely false, and I mean completely, not mostly. The United States uses what's called a progressive tax system, which just means your income gets taxed in layers, like filling up buckets. The first bucket of your income gets taxed at 10%. Once that bucket's full, the next bucket gets taxed at 12%. Only the dollars that spill into a new higher bucket get taxed at that bucket's higher rate. Getting a raise that pushes your top bucket from 22% to 24% does not mean your entire income suddenly gets taxed at 24%. It means the new dollars on top, and only the new dollars on top get taxed slightly more. You will never, under any circumstance, take home less money overall because you crossed into a higher federal bracket. If someone tells you that, they are wrong, and I want you walking away from this video knowing exactly why they're wrong. So, if that's not the trap, what is? Here's the part that actually matters, and here's why almost nobody explains it to you. The tax code isn't just built on brackets, it's also built on a completely separate system of income thresholds. And these work nothing like brackets. A bracket is gradual. A threshold is a cliff. With a bracket, $1 more costs you a few extra cents. With a threshold, $1 more can cost you thousands. Because the moment your income crosses a specific line, an entire benefit doesn't shrink. It disappears. Not partially, entirely. And your raise, the exact same raise that's supposed to make your life easier, is very often the thing that pushes you across one of these lines without you ever seeing it coming. Let me show you the first one, because it's hitting more families this year than almost any other, and it's connected to a law that changed on January 1st. If you have kids, you're probably familiar with the child tax credit, worth up to $2,200 per child on your federal return. Here's the mechanism nobody explains. Once your income crosses a specific threshold, the credit doesn't fade out slowly. It gets reduced by $50 for every $1,000 you earn above that line, dollar bucket by dollar bucket, until it hits zero. Take a married couple with 2 kids sitting right at the edge of that threshold. A raise of $40,000 combined which sounds like an enormous win on paper, can wipe out the entire credit for both children. $2,000 gone in a single tax filing from a raise that felt like nothing but good news when the offer letter arrived. To put the mechanism in plain numbers, for every $1,000 a joint filing couple earns above their threshold, they lose $50 of credit per child. Cross the line by $40,000 combined, and that's 40 separate $1,000 increments, each one shaving $50 off, which is exactly how a family with 2 kids loses the full $2,000. It isn't a cliff quite as sharp as the ones we're about to get into, but it's steady, it's mechanical, and it happens completely silently until your accountant hands you the number the following spring. Nobody calls you to warn you this is coming. It just shows up as a smaller refund, or worse, a balance owed, the following spring. And most people spend weeks trying to figure out what they did wrong on their taxes when the honest answer is nothing. They just got a raise at the wrong income level. Now, let me show you the one that's doing the most damage this year, because the timing on this one is almost cruel. If you or anyone in your household buys health insurance through the ACA marketplace, meaning healthcare.gov or your state's exchange, rather than getting it through an employer, listen closely, because this is the single most dangerous threshold in the entire tax code right now. It's called the subsidy cliff, and here's exactly how it works. The government caps how much of your income you have to spend on a marketplace health plan using a subsidy called the premium tax credit, as long as your household income stays under 400% of the federal poverty line. For 2026, that's $62,600 for a single person, $84,600 for a couple. Stay under that line even by a single dollar, and your premium is capped at a manageable percentage of your income. Go over that line, even by a single dollar, and the entire subsidy disappears. Not gradually, completely, in one shot. There used to be a temporary rule protecting people from this exact cliff, capping premiums at 8.5% of income no matter how much you earned. That protection expired at the end of last year, and Congress did not renew it, which means as of right now, in 2026, the full-strength version of this cliff is back, and it is catching people who have never had to think about it before. Here's the mechanical detail that makes this worse than almost any other threshold in the tax code. Every year, if you had marketplace coverage, you file a form called Form 8962 alongside your regular tax return. And that form reconciles the subsidy the government estimated you'd need at the start of the year against what your actual income turned out to be. If your actual income comes in higher than what you estimated because of a raise, a bonus, extra hours, anything at all, the form doesn't just adjust your subsidy for next year. It looks backward at every single month of the year that just ended and demands back whatever was overpaid, all in one lump sum. As part of the tax bill you file the following spring. There used to be a repayment cap that softened this for people close to the threshold, limiting how much could be clawed back based on how far over the line you were. That cap disappeared this year too, which means for 2026 there is genuinely no ceiling on how much you can be asked to repay if your income crosses that line. Here's what that actually looks like in dollars, because I want this to feel real, not abstract. Take a couple in their early 60s, a completely normal situation, both still working before Medicare kicks in, at an income of $84,500. Just under the line, their monthly premium might sit around $100, thanks to the subsidy. Give that same couple a raise of $200, nudging their household income to $84,700, $100 over the threshold, and their monthly premium can jump to over $1,100. Not a typo. A $200 raise costing them over $12,000 a year in lost health insurance subsidies. That is not a bracket, that is a cliff, and it is one of the only places left in the entire tax code where a single extra dollar of income can functionally cost you more than the government of most countries would ever tax you on that dollar. Analysts who study this have actually calculated the effective rate on that one crossing dollar, and it comes out well over 1,000,000%. I want to say that number again slowly because it sounds made up, and it isn't. Over 1,000,000% on one single dollar because of what it triggers on every dollar around it. And here's the part of this that genuinely upsets me. If you received these subsidies in advance, meaning the government paid your insurer directly every month based on an income estimate you gave at the start of the year, and your actual income for the year ends up over that line because of a raise you got in June or a bonus you weren't expecting, you don't just lose the subsidy going forward. You have to pay back every dollar of subsidy you already received for the entire year all at once when you file your taxes the following spring. Exactly the way I just described, which means the full repayment, potentially thousands of dollars, arrives as a single surprise line on your tax return, months after the raise that caused it, at a point when you've long since spent the money and moved on with your life. There's a third version of this trap that catches an entirely different group of people. And if you have federal student loans, this one applies directly to you. If you're on an income-driven repayment plan, your monthly payment isn't fixed. It's recalculated once a year based on your income from your most recent tax return. That recalculation is called recertification, and here's the mechanism nobody walks you through when you sign up for one of these plans. A raise doesn't gently nudge your payment up by a few dollars, because your payment is calculated as a percentage of your adjusted gross income above a poverty line floor. A meaningful raise can push your monthly student loan payment up by $200, $300, sometimes $400 a month, the very first month after your new income gets certified. Picture someone earning $55,000 paying around $210 a month under one of these plans. Give them a $7,000 raise, a genuinely good outcome by any normal measure, and depending on which plan they land on after this year's changes, that payment can climb toward $500 a month or more. That's not a one-time hit like the ACA cliff. That's an extra $300 gone from the budget every single month for the entire year until the next recertification, all traced back to a raise that was supposed to make things easier. People coming off the plan that used to cap payments more generously are already seeing jumps like this simply from the plan itself changing, and layering a raise directly on top of that transition is catching an enormous number of borrowers completely off guard this year. The raise arrives in your paycheck as a small, steady bump. The student loan payment adjustment arrives as one lump increase all at once, the month your servicer processes your updated income. Two completely different timelines, both triggered by the exact same event, and only one of them shows up on your pay stub where you'd actually see it coming. There's a fourth version worth knowing even if it applies to a smaller slice of you, because it tends to catch people right as their careers really start taking off. If you contribute to a Roth IRA, there's a MAGI threshold on that too. For 2026, a single filer loses the ability to contribute at all once their income crosses $168,000, with the contribution shrinking gradually starting at $153,000. For married couples filing jointly, that window sits between $242,000 and $252,000. A promotion, a bonus, a spouse going back to work full-time. Any of these can push a household from fully eligible to partially eligible to locked out entirely within a single tax year. And if you've already contributed the full amount for the year before your raise lands, you can end up with an excess contribution that the IRS requires you to correct, with penalties attached if you miss the deadline to fix it. It's a narrower trap than the other three, but it's exactly the kind of thing that quietly punishes people. for doing well. I want to be honest with you about why none of this gets explained anywhere. It's not a conspiracy. Nobody sat in the room and decided to keep this quiet. It's just that these systems were all built separately by separate departments at separate points in history, and none of them were designed to talk to each other or to you. Your payroll department knows your new salary. The IRS calculates your bracket. The ACA marketplace calculates your subsidy of a totally different income definition on a totally different timeline. Your student loan servicer recalculates once a year based on whatever your last tax return said, which is already old news by the time they use it. Nobody in that chain has the job of sitting you down and saying, hey, before you accept this raise, here's what it's actually going to do to the other 4 numbers in your financial life that are quietly connected to your income. That job doesn't exist, which means it falls entirely on you. And if nobody ever told you these thresholds existed, there was no way for you to know to look. What makes it worse is that every one of these thresholds is measured against a slightly different definition of income. The child tax credit uses modified adjusted gross income. The ACA subsidy uses a version of modified adjusted gross income that adds back certain items and measures it against the federal poverty line for your household size. Student loan recertification uses your adjusted gross income straight off your most recent tax return, which could be well over a year old by the time it's actually applied. The Roth IRA uses yet another version of modified adjusted gross income with its own specific add-backs. 4 different names for what sounds like the same thing, 4 slightly different calculations, and every one of them landing on a different dollar amount for the exact same household in the exact same year. Nobody expects you to memorize all 4 formulas, but knowing that they exist and knowing that a single raise can nudge all 4 of them at once in different directions is genuinely half the battle here. I'll tell you honestly, I didn't fully understand the ACA cliff until a viewer emailed me about it after a video I did on marketplace insurance last year. She told me her husband picked up some extra shifts near the end of the year to cover Christmas. A genuinely kind, ordinary decision, and it pushed their household about $600 over the threshold. $600. They owed close to $9,000 back to the IRS the following spring. Money they had already spent because they had no idea it was coming, and no reason to think a few extra shifts in December could possibly cost them that much in April. That email is the reason I started digging into this properly, and it's the reason this video exists at all. What stuck with me wasn't even the size of the number. It was that she told me the extra shifts were her husband's idea, something he did specifically to make the holidays a little easier for their kids. The exact instinct that's supposed to be rewarded in a functioning system is the same instinct that triggered the bill. That's the part of this whole thing that genuinely bothers me. And it's why I'd rather spend 20 minutes explaining the mechanics than let one more family find out about it the hard way. If you take one thing away from everything I've just walked through, let it be this. Comment below and tell me whether any of these 4, the child tax credit, the ACA subsidy, student loan recertification, or the Roth IRA Phase-Out, actually applies to your household, because I genuinely want to know how many of you are sitting closer to one of these lines than you realized. So here's what to actually do, and I want to give you concrete steps, not vague reassurance. First, if you're anywhere near the child tax credit phase-out or the ACA subsidy cliff, the single most useful tool you have is a pre-tax retirement contribution. Money you put into a traditional 401k or a traditional IRA reduces your adjusted gross income dollar for dollar, which is the exact number these thresholds are measured against. If a raise puts you $800 over the ACA cliff, an $800 traditional 401k contribution, something you are probably going to do eventually anyway, can put you right back under the line and preserve a subsidy worth many times that amount. A health savings account works the same way if you're on a high deductible health plan. and it has the added benefit of never expiring, unlike a flexible spending account. Second, if you're on an ACA marketplace plan, do not wait for tax season to find out where you land. The moment you know your raise is happening, log into your marketplace account and update your estimated income for the year. This does two things. It lets you see immediately whether the raise pushes you over the 400% line, and it lets you proactively lower your advance subsidy payments before the year ends, which spreads any adjustment out gradually instead of hitting you as one enormous bill in April. Waiting until you file your taxes to find this out is the single most expensive way to learn about this cliff. Third, if you have federal student loans on an income-driven plan, don't let Recertification catch you by surprise. Use the Department of Education's loan simulator before your recertification date. Plug in your new salary and see exactly what your new payment is projected to be. If the jump is going to strain your budget, you have options worth exploring before the increase takes effect, including whether a different repayment plan makes more sense for your specific situation. And that's a conversation worth having with your servicer directly, rather than discovering the new number for the first time on a bill. And fifth, if you're contributing to a Roth IRA, and a raise or bonus midway through the year might put you near those MAGI thresholds. Don't wait until you file your taxes to find out you overcontributed. Check your running total income against the threshold before you make your final contribution for the year. And if you're already over, most custodians can process a straightforward withdrawal of the excess plus any earnings before the tax deadline, which avoids the penalty entirely. It's a 5-minute phone call now versus a messier correction later. And sixth, whenever you're offered a raise or a bonus that might sit near any of these lines, actually do the arithmetic before you say yes or before you decide whether to take on that extra shift. I'm not telling you to turn down money. I'm telling you to know exactly what a few $100s in one direction actually nets you once every connected system reacts to it, instead of assuming that more income always simply means more money in your pocket, because near these specific lines, that assumption can be flatly wrong. Let me leave you with a case that went the other way, because I don't want this video to feel like it's only about avoiding disaster. A man named Corwin, 52, wrote in after watching an earlier video of mine and told me his company offered him a raise that would have landed his household about $300 over the ACA threshold. He almost didn't think twice about it, because who turns down a raise? But something from that earlier video stuck with him. So instead of just accepting it and hoping for the best, he sat down, ran the numbers the way I just walked you through, and asked his HR department if part of the raise could instead be directed into his 401k as an increased contribution rather than straight salary. They said yes without hesitation, because from the company's side it cost them nothing extra either way. They were happy to structure the compensation however he preferred. He kept the full value of the raise in his overall compensation, stayed under the ACA line, kept every dollar of his subsidy, and increased his retirement savings at the same time. One phone call, 5 minutes, and he turned a potential $12,000 mistake into a win on two fronts at once. That's genuinely the best possible outcome here, and it was available to him simply because he checked before he accepted, not after. That's really the entire message of this video, if I'm honest. A raise is good news. It should stay good news. But somewhere in the space between your offer letter and your next tax return did 4 or 5 separate systems, all quietly watching the same number, all reacting completely independently of each other, and not one of them is going to call ahead and warn you. The bracket myth gets all the attention because it's the one everybody's heard of, even though it's the one that was never actually true. The real traps are the ones nobody talks about, sitting exactly where you'd least expect to find them, in the fine print of a health insurance, subsidy, or a student loan recertification letter you barely skim. None of this means you should hesitate the next time someone offers you more money. It just means the offer letter isn't the end of the conversation. It's the beginning of one you need to have with yourself, ideally before the new number shows up in your account, rather than after. Check your numbers before the raise lands, not after. That's the whole difference between a genuine win and a very expensive surprise next April. I'm Faisal. Thank you for listening to Sheikh Faisal.